the immovable force that is seasonality. I always like to remind clients and investors, even the market was even up in December of 2008. So you certainly have something of the strongest period of time for the market working in your favor. But again, there's a uniqueness to 2022 that I think sort of trumps all historical analogies. So the short answer is I don't have any idea.
Do we have more central bank or added central bank risk, mistake risk, that we didn't have a couple weeks ago? I mean, we're always wondering what the implications of these rate hikes is going to be at the end of the day on the economy. But now this week, that morphed into a real worry that something big is going to break. And I'm thinking about what happened in the UK, right? And the intervention there. Marko Kolanovic, you know, we cite him all the time. JP Morgan. He says he's increasingly worried about central banks making a policy error. And this is one of the guys who was more bullish than most, or at least trying to keep his head above water as everybody else was sinking. He's worried about geopolitical tail risks following the destruction of Nord Stream pipeline. Are these new risks that we have to worry about now?
Well, whatever's going on with the pipeline, I guess, is new. But I would take issue with the idea that the risk now is a policy mistake on the part of the Federal Reserve or the central bank community at large. The risk, the mistake, the error has already been made. And that was allowing inflation to get as high and as durable as it did and has become. What they have to do now to curtail it is not the risk, but the appropriate response. Now, again, part of the issue here is imbuing a sense of not immortality, but supremacy on the part of a group of humans sitting in a room trying their best to try to bring inflation back down. The error, so to speak, ignores the repetitiveness, and we've discussed this for 12 months now, throughout history, of error after error after error being made. Not because someone does something wrong per se, but because humans are fallible. You over-tighten, you overstimulate, and the result is the same every time.
But the issue that I think we're speaking of, the risk is compounding your mistakes. Right? You compound your error by doing too much too quickly because you were too late in the first place.
But this is
and then you come in like the BOE did in the UK and make everybody even more nervous. Sure. A moment of hours, right, where you had a relief rally on the day we were at delivering alpha this week.
Well, this is the issue with monetary policy. It's very much like a water faucet in an old motel, where you turn the water on hot and it doesn't come out right away, so you make it a little hotter and it doesn't come out right away, and the next thing you know, you're in the shower with third-degree burns and you have to go back the other way and overstimulate, so to speak, towards cold. That's monetary policy. It doesn't react right away. Not that Jay Powell and Lael Brainerd don't know this, but it is an illustration of the idea that monetary policy works with long and variable lags, and because of that, it is very difficult to calibrate policy in real time with any semblance of honest perfection.
Okay, how many Targets and Walmarts and Nikes and FedExes and Carnivals do we need before we say, Houston, we have a problem? Well, and earnings are going to be challenged at best. There's too much inventory, okay? There's too much inventory everywhere, whether it's sweatshirts or cruise ship seats. Carnival told you that today, right? They have to do heavy discounting. Another thing is, it seems to me that a lot of companies have lost pricing power. Now they have to eat it, and that means margins go down.
Listen, I agree, but to the point about how many do you have to see before blank, I mean, we're finishing the year down 25%. I want to stress for the viewers at home, a 25% decline in the S&P 500, granted from relatively elevated valuations, is an exceedingly large drop in stock prices. There's this idea that, if you're not down 50%, it's a cakewalk. A 25% drop in stock prices is a real deal, and as we know, any number of stocks beneath the headline are down 67%. 60 or 70%, having topped out in December of last year, or perhaps even earlier in the case of some of those low profit tech stocks. But I would argue the market is reacting appropriately to the combination of the worsening fundamentals in corporate America and the consistency with which Federal Reserve and central bank individuals are reminding people that it is not risk assets that is their primary objective, but the controlling of inflation.
Right. But if you think that they may break something and the economy is going to be worse off as a result of that, and earnings projections, there's still 8% earnings growth for next year. Hasn't even been taken down yet. So if I tell you the economy might be worse because of the Fed, and earnings may be worse than we think for all of the reasons that I just told you, oh, by the way, the dollar is a problem too, is the stock market adequately pricing all of that in?
So first of all, I don't think so. I've made the case that I think we're probably going to make lower lows. We're in the process of making lower lows. But with respect to earnings, and I know everyone comes on and says this, 9 of the 11 sectors have lower earnings estimates today than they did in, say, March. 9 of the 11 sectors are lower. Part of the problem for the headline is, despite its small size, the energy sector has enormous earnings expectations, at least for this year. Next year, obviously, not quite so much. You are seeing that start to happen. I don't know that we need to have EPS estimates go down 200, 190, some people are positing. I don't know that you need to go down that far, but you're in the process right now, and perhaps third quarter earnings season will accelerate it. You're in the process of reevaluating what things are going to look like over the next 4 quarters. And so when you say, well, we're trading at 15 times the next 4 quarters, 16 times next year's earnings, whatever it is, that probably has to come down a little further, which, again, to reiterate, results in the S&P ending up somewhere in the 3,000 to 3,500 range, give or take.